Hello, it's Peter Merrick, and today we're going to be talking about cross-border planning between Canada and the United States. In the last 3 years, there's been a fundamental change. People who've lived in locations for their entire lives are now contemplating moving. And the best place for a Canadian to move is the United States because there's the US-Canada treaty, the tax treaty, and it's only been changed 4 times. It trumps both the IRS tax codes and the Income Tax Act. And today we are going to be speaking with 2 experts from a company that specializes specifically in cross-border planning, State Bird Corp. We are going to be speaking to the principals of this company, Bryant, Andrus, and Mark Ameerali. This is something that I've wanted to do for such a while because since I moved to the US, I got all these friends who I didn't know existed. They all called me up and said, how do I move down to the States? And I kept on hearing it enough. And I said to myself, I'm not the guy to speak to. Let's talk to the experts. Bryant, thank you so much. And Mark, thank you for being on this interview and having this conversation with me about how someone could move from Canada into the US and be better financially off than they would be if they were in the United States. Gentlemen, tell me a little about yourself.
Peter, thank you so much for having Mark and I on your program. This is such a fantastic, fun topic for us because we're in it every day. And really what we find is people, once they understand the possibilities, they're very apt and open to learning more about it because people are able to cut their tax rates significantly by spending more time in the US. They're able to leave more wealth to their families. They're able to solve tax issues, money management issues, and other legacy issues by having access to both sides of the border. It's about taking the best of Canada, best of the US, capping it over with the treaty to give yourself protection. It's really a fun, interesting, dynamic topic to talk about. So thanks for having us.
Thank you.
Yeah, thank you for having us, Peter. I know we've tried to set this up for a while. I'm glad that we're able to do it now. There's a lot that people can learn from this conversation about how they can increase their freedom and their flexibility to live where they want and be in a place that appreciates them.
Well, I think it's really important that people have options because information means nothing without the application of it. And what we're going to be talking about today is, Mark, you worked on a few examples that would illustrate what are the benefits of an individual who's living in Canada right now, who's always thought about living in the United States, however, did not know where to begin and who to contact. And maybe you could share some examples to illustrate what we're talking about, the treaty, the Canada-US tax treaty, and the benefit it affords Canadians who choose to make the move.
Sure. I mean, I would start off by introducing the idea that State Bird Corp is a firm that helps Canadians and Americans deal with their cross-border issues. Those issues can include legal issues, immigration issues, taxation issues, organizational restructuring issues, financial planning, estate planning, and all of the above. We sit at the intersection of all 3 of those challenges, and we coordinate or quarterback different professionals to come up with critical paths to the success of the client, the end user, in terms of what they want to accomplish with their life and what their goals are. So State Bird Corp was founded in 2020 by Bryant. And Bryant, I'm not sure if you want to speak to that in terms of your background and experience in the space before I go into the examples.
Sure. Yeah, let me give you a little bit more background around why we're doing what we're doing. So my career personally spans 15 plus years of doing just cross-border work. When we talk about our team, including Mark, extensions of our team like Peter, other professionals that we quarterback, we're well over 100 years combined of just cross-border experience, financial services, legal, and tax work. And the idea here is it's a simple concept. In a previous company that I was with, we help people move back and forth all the time. what was happening was that the world was changing. And so we were trying to adapt things to a new world that we were living in. Changes of the Trump tax cuts. We had changes in the governments with the oil prices falling out. We had immigration changes in Canada. We had immigration changes in the U.S. All these things are always changing dynamically. And so from a standpoint of where can we help our clients the most? Well, my family and I spent about 6 years in Canada living full time. We're originally from the U.S. When we moved, we separated from our last company and moved back to the U.S. And I went and worked with just a general big bank here located in the U.S. And I found that you couldn't really navigate the waters of the cross-border world inside the confines of a big institution. We have to be more nimble. You have to be more flexible and more focused in on multiple areas of what they call multidisciplines. And so, as Mark alluded to, we're operating at the intersection of legal, tax, and finance, and operating that circle gives us a vantage point to be able to coordinate these specialists, almost like a general contractor coordinating all these trades, so that when your house is built, your dream is built, because we have someone quarterbacking all the different aspects of it. So State Bird Corp was formed for the sole purpose of quarterbacking all the different professionals to help the clients achieve their goals, not our goals, but their goals of living a cross-border lifestyle free of the border. In other words, they can go back and forth as much as they want. A former partner of mine used to describe it as a revolving door. So the border doesn't exist anymore. You go back and forth as much or as little as you want. And that's what our company's designed to do.
Mark, you've sat down and you've prepared some illustrations and explanations and examples that show the benefit of someone who decides to move to the United States from Canada. Can you share those examples with me?
No problem, Peter. Thank you very much. I'm going to introduce the examples that I created by way of focusing on 3 different benefits that we try to focus on for the clients and the end user. The first one is the fact that when someone's anticipating a move internationally, they have a lot of questions. There's a lot of different areas that they can focus on: immigration, tax, etc. And there really isn't a single one-stop shop to find the answers that they need. So we try to provide the answers, to be that point of contact, to be that end-to-end concierge solution for the client, that they always feel like there's someone guiding them through the process and holding their hand. It is very difficult to overemphasize the peace of mind that a client gets from being able to have one single point of contact to answer their questions. So that is one of the first things that I want to highlight as a benefit that our clients get from working with us. The second is a focus on the immigration and the critical path, how they are going to move from Canada to the US and by which immigration path they would go down. And the third is the departure tax. This is one that many people don't immediately think about first, but it is one of the things that they focus most on, because the departure tax that one would pay leaving Canada to come to the US can sometimes be prohibitively expensive. For example, if you own a business that is illiquid, you may not have the liquid capital to be able to pay the departure tax to exit Canada and come down to the United States. And so that's something that needs to be planned for and planned for very effectively. And the longer the runway that we have to plan for that, the more effective that we're going to be in helping the client solve these challenges. And then tied to that, what I would say is the idea that when you do pay the departure tax or the exit tax, leaving Canada and coming to the US, because of the treaty and the tax rules in each country, you do have the ability to apply the taxes that you paid for the departure tax and the taxes that you may be paying ongoing up in Canada and apply them to a US tax liability in the future. So I'd say on the tax side, it's much more about reducing or eliminating as much of that departure tax as possible. And then that would eliminate or reduce the need to recapture or utilize those tax credits on a go-forward basis. So the examples that I created show a little bit about how different scenarios can come about where that departure tax can be reduced and those foreign tax credits can be utilized on a go-forward basis. And for the record, the IRS, the income tax code, the Internal Revenue Code allows for a 10-year utilization period. Once the new immigrant comes into the country, their departure tax, that's a valid credit that they can use for a 10-year period. And every year they have ongoing current income, they can generate new foreign tax credits from Canada and utilize those in the current year. And you have to use those before you go backwards to use the previous ones. Bryant, did you want to add anything to that?
Thank you, Mark. It was a great technical explanation and things. One of the things that when we start talking about moving back and forth, we always take it back to the what's our starting point, what's our goal. So let's go through the kind of background of these clients. We've got a mom and dad executive who could be coming down to the U.S. for a work transfer, or they've retired early in their career. They have young kids at home still. When I say young kids, and the teenager, and so they have dependent kids at home. They have some cash. How to structure it to coordinate the immigration and the tax exit that Mark was referring to, and how to optimize that. Most people, when you go to an immigration attorney, they'll say, oh yeah, there's one or two ways to get to the US. And the reality is there's one or two big ways, but when you drill down into the different visa types, there's lots of different ways to get to the US. So it's about finding the right immigration path. Then we jump over to the other side of the ledger and say, okay, if you were to become a US resident for tax purposes, what does your tax situation look like? You have a deemed disposition that Mark referred to. You have potential loss of health of Alberta healthcare, or when I say Alberta, provincial healthcare. You wouldn't be eligible to use the system anymore. You have property and casualty insurance. What do you do with your home up there? Do you have to sell it? No. Well, some people will tell you have to sell your home, or you have to sell all of your assets. Can you own and maintain or run a business in Canada, but from the US? Short answer is yes to all those questions. We had a client one time who had a manufacturing plant in Maple Ridge, BC, but he lived full-time in Palm Springs. And I remember going over to his house one time, and he said, Brian, I want you to come and look at my cockpit. I said, cockpit? You're not an airplane pilot. But I walked in, and he literally had computer monitors all the way around 180 degrees, and he had his entire manufacturing plant built into where cameras everywhere. He could sit there and push a button and talk to his employees through the camera. He was running the company from the US. And this was 10 years ago. Imagine what the technology is today. So those type of things, many people will tell you you can't do. Well, when you have the right quarterback, have the perspective of understanding immigration and the tax, we can accomplish those goals. So like what Mark was referring to, there's some technical aspects to it, but what are your goals and your objectives? What type of savings? So this young executive making a few $100,000 a year, plus you've got some RSP money, plus you've got a house, plus this and plus that, they could be looking at several $100,000 in exit tax. With the right planning, we can cut that down by a quarter to half to 3/4, depending on how much runway we have. And even if let's say we did a more conservative approach, we save a quarter of the exit tax, we can then recover the 3/4 from the IRS over the next 10 years through the right income allocation. But it takes the coordination of the tax structure, the immigration, and the finance side. Here's an example of what could happen if you don't have a quarterback. Like we had a client a number of years ago that they didn't want us to coordinate the tax side and the immigration side. Okay. They already had the immigration attorney before they met with us. So they went and they continued to go. And all of a sudden we had this great tax plan put together. It was a very, very creative tax plan that's going to save them about 3/4 of their exit tax. And then that a quarter that they were going to spend, we're going to be able to defer it. So we eliminated some, and then we deferred some. So it was actually a really cool plan. Well, about halfway through the implementation of that plan, all of a sudden a green card showed up. Well, that green card was a material game changer, because as a US tax person, we couldn't do the structure we wanted to do. We could own the structure afterwards, but we couldn't finish up the transactions because from a US perspective, it would have been taxable because they had this green card in place. So you had your right hand, the immigration just going along, just do what they're doing. Their goal was to get the green card. They did a great job. But because it wasn't coordinated with the left hand, the tax plan, we literally had to unwind the tax transaction, surrender the green card, and start all over. And it cost clients hundreds of thousands of dollars in legal fees to do so because the right hand didn't know what the left hand was doing. That's I can't emphasize that enough. You have to be coordinated back and forth. Whether it's a retiree who's got $20-30 million net worth, we have to coordinate both sides. Or it's a $5 million or a $1 million. If they're not coordinated, you are asking for trouble. So Peter, tell me a little bit more about your experience, because I know you have an experience when you hightailed it out of Canada. What issues did you have that you wish you would have known? And maybe let's talk about some of those.
Well, I'll tell you the thing that I was excited about. I counted my days in Canada, and I made sure that the house was in my name because my wife was an American, and I turned it into a rental, and I had it evaluated at quite a high price. And then COVID happened, and then I sold it. So I ended up having a loss. And that loss I was able to apply to gains. And it was something that I had planned. And the emphasis that I will share with everyone is you plan. You don't wake up one morning and you're down in Florida and you say, hey, I want to be here. You have to actually go down to Florida and say, I'd like to be here, but I can't be here now. I got to go back and plan to make sure that when I do come here, all the things I have that I'm leaving are able to come with me, and they don't remain with the Canadian government with Revenue Canada.
Peter, that's a really good point. And let me tell you a little ancillary story about that. I was in Calgary, and I was sitting in my office. I got this phone call mid-morning, and this guy said, "Hey, we found your website. You do a lot of things we want to do. We're planning on moving to the U.S." Oh, great! So we're talking for a little bit. I said, "Well, what's your timeline? How much runway do you have before you want to move?" Well, I'm sitting here in the Calgary airport, and I want to move. We're planning on moving right now. I'm going to send the movers back up to get my stuff and come back down. So what can you do to help me? I said, nothing. I said, if you want me help, you're going to stand up, walk out of the airport, can't lose the money on your flight. I don't care. You're going to go home, and you're going to come to my office tomorrow morning. Because if you want to exit today, there's nothing we can do. We need time to be able to get these things in place. For example, if a person moves across the border with something called a tax-free savings account, that's considered a foreign trust. Foreign trusts are hot button issues for the IRS right now. And as you alluded to, Peter, earlier, the tax treaty has only been changed 5 times since it was created, and it hasn't come up to include any provisions for a tax-free savings account. So just that one thing can cost you tens of thousands of dollars. Here's another thing. If you're a beneficiary of a family trust, you move to the US, you may or may not have, and you get distributions from it each year, you may or may not have throwback tax, you may or may not have a beneficial interest to a threshold of what the IRS has to report on. So you may have just added $10,000 to $15,000 a year of extra compliance costs. Now, there's no savings or no extra tax. It's just straight accounting bills from your accountant. So it's these type of things we can restructure. We have time to restructure.
Do you have an example of an executive younger family that decides that they're going to move to the US from Canada and to share through planning and time the benefit that they will receive by sitting down with State Bird?
Absolutely. Bryant and I have created a couple of examples that combine many of the clients that we've seen and the challenges that they've faced that we can help resolve. So this example is of David and Sally Jones that live up in Calgary, Alberta. David is an oil field executive with a company that has headquarters in Houston and in Calgary. David's been working at the company for several years, and he's going to be transferred to the Houston head office, for example. Sally works from the home right now, but is thinking of getting back into marketing consulting at a future date. And they have 2 children, ages 15 and 13. They're both in full-time school, obviously, but eventually will want to get jobs of their own. So Jim's been working for the company for a number of years and has stock options. He has a great salary, makes about $400,000 Canadian a year. They moved down to Texas and they realized that they want to live in Texas permanently. Well, that's going to require some planning ahead of time. So that we don't trigger a large exit tax, one of the things that we want to do is talk with the Jones family and make sure that they have adequate planning and consider all the different challenges that they're going to face for an exit. So some of the things that they might want to consider is what does constitute an exit from Canada? Does just leaving the country and renting a house in Houston make you an expatriate? Does that make you a US tax resident? Does it require you to sell your home in Canada, as Bryant alluded to? Does it mean that you'll need to find different healthcare? Does it mean that you have to sell all of your Canadian assets? Does it mean that Sally can't work, or can she work? Can the children work? What are their options for going to school? And can they use any of the income from the houses that they own up in Canada that they've been renting out? And can they use the taxes that they paid on that income and use them as credit against their US tax liabilities? All of these are considerations that they will want to make before they pull the trigger on becoming US tax residents or immigrating to the US. And so for the example that we've made, the first thing that I'll reiterate is that we would make sure that David and Sally have someone that they can always go to ask any of the questions that they have, where that end-to-end turnkey solution, like I mentioned. And the financial result, the exit tax. So without a planning, if this family decided that they wanted to come down, they didn't communicate with anybody, and they decided that all of a sudden they're going to make that change and become US tax residents, without planning, they would be facing an exit tax in the range of about $650,000. That's on about a net worth of $5 million. That's a primary residence plus 2 other properties. That would be a vacation home on Vancouver Island and a rental condo up in Calgary, as well as some TFSAs, RSPs, non-registered accounts, and those private shares I was talking about. That exit would probably cost the family approximately $650,000. However, if we were able to meet with the family ahead of time, especially a year or 2 ahead of time, and plan for that exit, we would actually be able to reduce that exit tax by anywhere from $100,000 to $550,000. So that is a huge savings. And remember, anything that we save the client in the exit or the departure tax, we don't have to recover or utilize once they exit after the fact. Now, having said that, we are able to recover what we can't eliminate on the exit after they exit. So that would be a recovery from anywhere from $300,000 in tax credits to $500,000 in tax credits over a 10-year period. So the summary is, with the planning, that family will save somewhere between $150,000 and $550,000 in departure tax, and they will be able to recover somewhere between $300,000 and $500,000 in foreign tax credits. They'll have all their questions answered, and they'll financially be much, much better off.
Is if we look at his annual income, the annual income differential between Alberta and Texas is quite significant, and it's just a straight up function of the tax brackets and the write-offs, etc. So he can be saving somewhere between 1/3 to 1/2 as taxes, reduces taxes by 1/3 to 1/2 over what he's used to paying in Alberta. So again, there's more cash in his pocket. That's on the income tax side of things from his salary alone.
Do you, Mark, for a larger client, someone who, is done, they did really well in Canada, they don't want another winter? I haven't experienced a winter in 3 years now, and I don't think that I can deal with it. Just to share with you a quick story, I was brought to Denver for speaking, and I spoke, and then we went out for dinner later, and it was in November, and I'm wearing gloves and a toque or a beanie, whatever you want to call it. And everyone's looking at me and they're saying, "You're from Canada?" And I said, "Yes." He said, it was 0 degrees Celsius or 32 degrees Fahrenheit. See, Bryant, I know the difference.
You
right?
can convert it. I'm impressed.
So no, I just know that's the 0 is 32. That's where it stops. And they're looking at me and they're saying like, "You're from Canada. Like, why are you dressed up like with gloves and a hat?" And I said, "My blood is thin, and I don't think I can ever go back to have it get climatized again for a winter." And that's how many Canadians feel. They feel that they can't do it. And my joke is this: the rest of the world look forward to their Fridays for their weekends, the way that Canadians look forward to their summers.
Absolutely. So this next example, the executives that you were talking about, the retirees, the people who want to escape winter, in the example that we made, again, it's a combination of different clients and families that we've seen. This is Bill and Mary Smith. They're from Vancouver, British Columbia. That's my hometown. Mild enough, but you know what? The winters can still be dark and wet. And this family had been snowbirds for several years. They, in this example, have had a car dealership that they've built up over 35 years and is now worth over $20 million. They generate $1 million off of it annually, and they spend their winters in Arizona. They're now in their early 70s, and they've been snowboarding for decades, and they're ready to make the permanent switch. Their children are grown up. They have 3 sons. They're transferring the management of the business to the sons. They're going to retain the ownership of the business for a time, but they're going to transfer that eventually as well. And Mary likes being in Arizona because she's got a health condition that does better in the dry heat. So because they're in the car industry, they own multiple exotic cars. They're not huge fans of the markets per se, so they own gold bullion and some other hard assets. They have a commercial building that they own through a limited partnership, and they have a residence worth several $1 million. Their net worth total is in the $30 million range. Now, in this example, they have some considerations. One of the examples is healthcare, right? As I mentioned, Mary has a condition. She's going to want to know how she can make sure that that condition is handled if she is out of the country. How is she going to get healthcare? When should they sell the business? How long should they take to transfer it over? Can they manage the business from Arizona and not be triggering unfavorable tax treatment? What complexity does owning a limited partnership have? Or what about a family trust? They own the business through a family trust. How does a family trust complicate the matters? So there are several things that they're going to want to investigate prior to making a permanent exit, and that we could help a family like this be that point of contact, that white glove concierge service that I was mentioning, to have those questions answered so that they never feel like they're lost in the wind or floating without direction. So in this example, we would talk with the family, make sure that we know what their goals are, what they're aiming towards. We would develop that critical path. We would coordinate the accountants, the lawyers, and all the professionals needed to make sure that what's being done needs to be done at the right time. Bryant alluded to this earlier. It's very important that you coordinate all of those professionals together at the right time. And unfortunately, it's not something that naturally comes to professionals who are very autonomous and competent. They don't usually have to coordinate an accountant with a lawyer for something like this. They usually would do their work independently, and the right hand wouldn't know what the left hand is doing. So that is one of the most important functions that we serve, seeing the whole picture and guiding the client down that critical path. Then the financial result comes. So if they didn't plan, any lack of planning here could result in an exit or departure tax in the range of $6.2 million or more. Now, if they were able to plan ahead for that, that could be reduced anywhere from $2 to $4 to $5 million for this particular type of client, depending on how long the runway was and how they managed the tax, the departure tax, and then the utilization of those foreign tax credits. So again, over a 10-year period, the amount that could be recovered over foreign tax, the foreign tax credits that can be utilized would be approximately $600,000 to $1 million over that 10-year period, depending on different factors, how much income they have drawing from the business and what they end up doing when they get to Arizona. So again, we see here where that planning runway is very critical, absolutely critical to making sure that the client is financially better off. And again, just a smoother experience. You don't need to make a move that is sudden and causes disruption in your life and your stress because you don't know what you've just done and what the implications are for the goals that you've set out for yourselves. Having that goal clearly defined and having the clients move down that path is absolutely critical for a smooth, comfortable experience moving from north to south. Bryant, do you want to add anything to that?
Yeah, I would love to. Thank you, Mario. It's a great explanation of the higher net worth clients. The higher net worth you are, the more savings you're going to be. So it's a magnitude question. We had a client one time to give you an idea of the magnitude. This client was worth several $100 million, a very successful oil business. And in one swoop, we could save them about $45 million on a 21-year deemed disposition of the trust that they had set up years ago. And on an annual basis, we could save them about $3 million of tax. But there's a but. That's the way it goes back to the goals. But grandma would have to spend 3 more weeks in the U.S. away from grandkids. It would, because of the structure that she would have to go into, there was no flexibility. She had to stay out of Canada for 6 months a year. Many times it's not the case. Actually, most times, as long as you're close to that 6 month, because of the treaty, because of the way we can set things up, you're okay. But in their situations, she had to spend the extra 3 weeks out of Canada. And she looked at me and said, "You're really asking me to spend 3 more weeks away from my grandkids?" The answer is no. And I sat back in my chair saying, "We'll buy you a private jet and fly them down for 3 weeks. I don't see the problem here. You're saving so much money. Why wouldn't you?" That was a long time ago when I had this conversation with them. And the more my kids have grown up and a few other things, I understand why she was saying, because the time with the family, the time with the close friends and family are more important than money. Money is just money. So having that goal clearly defined between husband and wife as what they wanted to do is really critical to allow us to put together a game plan. If she had known up front that it would have to be extra 3 weeks away from her grandkids, we would have not had to go through all the mental exercises because the answer would have been no up front. So having that clearly defined goal, and the reason we are emphasizing this so much is why we made some of the changes we made from our previous firms I've been involved with into State Bird Corp, is allows us, the way we have things structured, is to really hone in on those goals up front so you can see the entire roadmap before you make a commitment one way or the other. Most of the time, people are already spending 4 or 5 to 6 months down in the States and are wanting to spend a little bit more time with the flexibility to go back and forth and not worry about it. As we have those goals clearly defined, that phase 1 allows us to really hone in on that to make sure that we're staying on point and making sure that we're hitting all those key parts of their financial life.
And you brought up a good point there, Bryant. You mentioned the phases. So, Peter, our process works in a 3-stage process. We call it 3 phases. And what Bryant was just alluding to is phase 1. So in phase 1, we have that discussion with the client and we clearly define what the goal is. We determine what the strategy is to get down that critical path and we create the plan. We don't take action on the plan yet because that is phase 2. Phase 2 is the implementation of the plan that we created in phase 1. So that would be applying for the visas, reorganizing the organizational structure, and actually making that transition, acquiring the visa, coming down to the States, making the exit, whatever that end goal of phase 2 is. And then there is a third phase, which is more like a maintenance phase and could be extremely varied per client. That could be anything from a concierge CFO service where the client doesn't talk to their financial professionals, their brokers, their managers, and whatnot. We coordinate all that, and they only talk to us. That's one version of it. There's another version of a phase 3 where they do an annual check-in and they pay us on an hourly basis for that annual review, right? So it can be extremely varied on the phase 3 side of things. But the nice thing is for our clients is that every single phase is a segment of the relationship where they have the optionality to continue on another path afterwards. They can come to us for a phase 1, develop the plan, and they could take that plan and go and implement it themselves. They could implement it with other professionals. It's an autonomous relationship for the phase that they're in. Phase 2, they can go again, and they can go option to work with other professionals for their wealth management. They have that optionality, right? So at every phase, they have the option on what they want to do after that. We do not try to capture that client relationship for an extended period of time. We're hired to do a certain thing. And if they want to hire us for the next phase, they're more than welcome to do so.
And to be candid, we want a long-term relationship. There's no doubt about it. But we also recognize that not every client requires a long-term relationship. We work on the client's timetable, not the other way around. We're not going to put everybody into a box. We don't have a hammer. We have more tools than just a hammer, so not every client's a nail. And so there's lots of different ways of saying the same thing. Our goal is to have long-term relationships with clients. But we also recognize that clients need transparency, clarity, definity, defined projects, the scope, so they can assess the value of each phase. And we'll put our services up against anybody. And as long as we're adding value, we hope they stay. But the idea is that they can, or years ago, I had a client who was a multi-billionaire, who had a single family office. They needed us to come in and solve a specific problem. My old firm, wouldn't do that because they couldn't do everything for the client. We are set up to be able to come in and, again, consult, solve the problem, and if we need to, that's great. We solve some problems, everybody makes some money, client got value, we're off to the races. The idea is to have transparency, define projects, and create value at every step of the way as we work with our partners, Peter, yourself included, in that conversation, so that we can stay within our wheelhouse and our specialty. Everybody else can stay in their wheelhouse and specialty. And now we have a situation where it's a 2 + 2 = 5 for the benefit of the client. And then everybody's happy, and especially the client. Because again, our ethos is very simple. Rule number 1, the clients come first. Rule number 2, the clients come first. And rule number 3, if you're confused about the first 2 rules, maybe we shouldn't be working together. Because that's really is, we want to be that client-centric place. And all of our team members, internal and external, have the same philosophy.
I have one question that I would like to ask you, gentlemen, because my expertise back in Canada, I was a columnist for the largest accounting publication for 17 years. And I worked with a number of the top tax lawyers and tax accountants. And the one thing that none of them could actually deal with is they would do the planning, but they had no way to recapture those tax credits. And your firm has put together something which, the reason I like working with you is capturing those tax credits, because what you shared with me is you're also willing to work a specific project. So for example, if there is an accounting firm in Canada that is doing the planning, but they need their clients to implement something that's going to recapture the tax credits, you put together something very unique that allows a client to do it, because it's great. You whittle down someone paying tax instead of $500,000 down to 100,000. And now they go to the States and they paid 100,000 in in Canada, if they don't have the ability to recapture those tax credits, they've lost $100,000, and you have a structure that allows them to recapture it. In some cases, some of your clients have saved so much taxes, they might never have to pay taxes in the States.
Yeah, so let me walk you through that. I want to reframe something you said. Is we reduce the exit tax, for example, from 500,000 down to 100,000. They haven't lost that money. It's just a prepayment of the tax, because that exit tax is the same tax you pay upon your death. Let's talk about the RSP. Same thing. If you collapse an RSP as a Canadian tax resident, most likely you're going to be paying the top marginal tax rate. Alberta 48%, Ontario 53%, BC 52 or 53% as well. If you unwind that RSP as a U.S. tax resident, your top tax is 25% under the treaty. So you're saving that delta between the difference between the 25% and the highest marginal rate. Again, just use Ontario 53%. You're saving 28% already. So the tax credit recovery is like the cream of the cream, the frosting on the cake. We've already had our cake. Now we're going to have the frosting on top of the cake. So to answer your question, Peter, yes. One of the things that started with kind of the Statebird Corp came into existence was because of a lunch that our tax partner Saul Abrams and I had back in 2014. We sat around. We were at the Petroleum Club there in Calgary. And we started to say, hey, you know what? We've got these tax credits, general limitation foreign tax credits from these clients. How do we utilize them? And so his legal brain, my finance brain, we started going back and forth. And it took us quite a few years, but we were able to develop a legal structure that allows us to generate general limitation foreign source income. Then we bolted on the finance piece of the actual underlying investment that currently is first deed real estate that will kick off enough income, and we pass through the tax structure. On the back end, the clients are receiving general limitation foreign source income. And so up until now, we haven't been able to recapture those taxes paid. We can today. We have other solutions for the passive foreign taxes paid that will go there. And there's always a level of risk, and it's a client by client situation. Statebird Corp is not an investment firm or legal firm or accounting firm. What we do have those, we reach across the aisle to our partners, either a sister company or a partner company that handles the underlying finance piece of it, and the Statebird kind of comes in with the legal side and manages the whole thing. So we partner with several different people to be able to implement this, and this is unique. To my knowledge, there's not another firm out there, and I know most of the other cross-border firms that are able to generate general limitation foreign source income, full stop, and then the ones who can generate passive foreign source income, they're doing it in such a way that they're really not recapturing based off the ratios, the mathematics behind it. They're really not going to be able to capture enough of the passives to make it worthwhile. So Peter, you're absolutely right. This is something very unique to Statebird Corp. It took years to develop, and it's really beneficial. So if someone had an accountant that comes and says, I have this client with $1 million of foreign tax credits, they have 7 years left to use them. Can we burn them? Can we utilize them? Short answer is, well, let's find out. Let's do some math. Let me show you what our solution is. Let me show you the proof of concepts, the K1s that produce it. And then at that point, it's a mathematical exercise. Most likely we'll be able to. But again, it depends on very, very factors, and it's very unique to each client situation. But yes, we can recapture those foreign tax credits.
Excellent. Mark, is there anything before we wrap up? Is there anything you'd like to add?
Yeah, actually there is, Peter. One of the things that Bryant alluded to in terms of the prioritization of the client's interest and the client's benefit is it actually comes down to our fee structure. So when we work with the client, our goal is to have a minimum of a benefit for that client of 3 to 5 times the fee that we'll charge the client. So we want to make sure that the clients understand that the investment that they make in the planning relationship with State Bird Corp will pay dividends in multiples. So they're coming out in almost every single case where they've saved a magnitude of order larger than the tax or than the fee that they would pay us. They are saving that on their departure tax and their foreign tax credit utilization, as Bryant just went through and explained. So this really is an investment, and it's a very high return investment for them to do that planning. And as I mentioned earlier many times, the earlier they start that investment, the more dividends that it's going to pay.
Correct.
And Brian, is there anything you'd like to, any last thoughts?
This has been, Peter, this has been an absolute pleasure. I know you and I have been kind of working on and off together for a long time now.
Long time. I had hair.
Huh? You had hair back then? I don't know, not that much back then.
No. I didn't have hair.
But it's so much fun to work with the other team members, and both internal and external. And Mark and I love working with the bigger groups, because the more heads we have around the table, the better off for the clients. And again, to reemphasize, our goal is to accomplish the client's end goals. Our tagline is, do we create plans as unique as your fingerprint? Because every client's different. So Peter, thank you so much on behalf of State Bird Corp. Mark and myself, thank you for having us. Hopefully we'll be able to get together again when you have different topics. And again, anything you need to go into more detail, happy to talk in detail about all the different aspects of cross-border life.
Well, I believe any Canadian who is contemplating moving down to the United States, my recommendation is to sit down with the professionals over at State Bird Corp. I love being the stupidest person in the room of other professionals because I learn. And I want to thank you, gentlemen, for being on this call today. And I'm going to suggest that if you are, and I'm emphasizing this again, considering making a move from Canada, leaving the tyranny, I'm sorry it came out, we can make it as pleasant as possible by you planning properly. Gentlemen, Mark and Bryant, thank you so much for today. And I look forward to having many more conversations.
Thank you, Peter.
Thanks for having us, Peter. I'm glad we were able to do this.
Thank you. And the greatest healer for anybody later on in life is to mentor younger people. And I find this all the time. I sit down with business owners all the time, and they always give me unsolicited advice because they want to share their knowledge, and it's really important.
Here with me is Peter Merrick,
president of merrickwealth.com.
Peter is an income and capital enhancement consultant,
speaker and author.
He is also
a recognized expert in the world of succession planning.
Over 800 published articles and 3 industry textbooks.
He's a Canadian who joined us today from San Diego, California. Thanks for joining us.
So, Peter Merrick, tell us about you.
Well, I've been in the financial service industry since the end of 1991.
I graduated during the recession. The baby boomers were in their positions, so there was no jobs. So the two businesses that opened up were the technology field and the financial field. It was the Wild West in both of them. So I had this brilliant idea, and I had a friend of mine, and we started talking, and I said, hey, how difficult would it be for us to get a mutual fund dealer license? Not difficult enough. Thank God for those 10 years, the market just went up. I would sit down and I would take somebody's entire life savings that they spent 15, 20 years accumulating it, this young kid who knew nothing about nothing, and I would go and just invest it, and luckily it went up because the markets were crazy in the 90s. It was a boom time. But in 2004, my life blew up. I almost went bankrupt, but I was very fortunate because there were very few CFPs at the time, but every university in Canada wanted to offer the CFP program. So I got recruited as a prof. And it was great. I was reading all the textbooks. I would call all the big publishers. And what I came to the conclusion was The succession planning was missing.
One of the issues was there was very little talking beyond the accumulation stage. Like, how do you have a healthy life after you've done that?
I also looked at demographics. At the turn of the 20th century, the average life expectancy in the West and North America was 43 years old, and people are dying at 83. No one ever lived to 83.
Well, so I always say that there's two financial plans. There's the financial one that we work on, and there's what you're going to do with all your time and that energy once you're done. And with this thing that they've been racing towards, they've hit it. But if they haven't thought about what they're going to do after or how they're going to feel validation for their existence, they just never stop. They just keep going.
Well, it's not anybody's fault, because when people are young, they focus too much on doing, and later on in life, they have to focus on being.
So I wrote my own textbooks because
I thought it was very important to talk about how do you transition from the first half of life, which Carl Jung called it the morning, where you're accumulating, whether it's your ego, designations, education, houses.
the second half is deconstruction, giving wisdom away, giving away my money, giving away my time, leaving a legacy.
So talk to me about that stage. What's the purposeful way or kind of the best practices, ways, or considerations for people to take when transitioning into that stage of life?
Well, one, decide whether or not you want an exit. I find between the ages of 55 and 70, a lot of people feel that I'm just tired doing the same thing that I've always done, and I have the money now. So maybe I should get out when the going is good and pass on my business to someone who's got the energy to navigate it. Number two, who are you going to sell your business to? There's one issue about selling it to a family member or an employee. What happens after you sell it? Things don't go right. A lot of business owners want to sell their business because they just want to wash their hands. But by selling it to someone you know, you're not getting out of your business. The best is to sell to a third-party purchaser. The last one is after they make that transition from being a business owner, building a nest egg for themselves to have choice, they don't know what they're going to do. I've spoken to people who say, I'm going to take up golf. So my question is, do you golf now? I don't golf now. So what makes you think you're going to golf later? I just want to share with you guys a story. There was a gentleman, his name was Bob Hunter. He was quite a celebrity. He started Greenpeace during the height of my blow up. When I was going through business loss, he was bringing me on national television. And you know what he was doing? He was saying, so Peter, don't you do that? And then he would give my phone number and he would give my web address. The reason why it went by merrickwealth.com, because it was almost like a phone number that would run across the television and I could actually see myself making money off of it. And he was dying. He had prostate cancer. And he turned to me and said, Peter, one day you will be in a position that you'll help someone else. And let me share with you about the legacy. Bob's been dead for 16 years. And I'm sharing you the legacy of Bob Hunter because he made a difference for me. And if I make a difference in anyone else's life, I'm a product of those people who are willing to do things and they had no expectations. And a true mentor is someone who has no expectations that they're going to see the tree blossom.
The reason I wrote The King of Main Street is younger people don't know how to find the right mentors, and older people have this need to mentor. It's almost like a biological need because they can see beyond their physical existence. They know that the sun was here before them and it will be after them and what's going to be left behind that they leave.
I would joke, I can't make you money, but I can definitely save you money. What I mean by that is I am a Sherpa. That's someone who would guide someone to help them come down. But I realize the most precious asset they have is not their money. It's their time.
What last piece of advice would you like to give our listeners?
If you have a business, the most important thing to ask yourself is, why did you get into the business? And it's usually not to create a legacy, it's to create the lifestyle that you want. And at that point, ask yourself, what do you want to do during your last days? The last human freedom is to choose one's own beliefs, one's own way. Everything else you can have taken away from you. But what you believe and how you choose to act in the world, that is yours. And the greatest healer for anybody later on in life is to mentor younger people. And that is going to give you fulfillment emotionally, spiritually, and mentally. You guys have been wonderful.
And I want to thank you, and I hope you guys have a great day. Thank you.